If you live in Australia and have a home or investment loan, you've probably come across the terms redraw facility and offset account. They sound similar, and at first glance, they seem to offer the same benefits. But there's something important most people don't know: parking money in a redraw facility could cost you thousands of dollars in the long run. And surprisingly, even some bankers and brokers aren't fully aware of this trap. Today, I'm going to explain exactly how this works. And by the end of the video, I guarantee you'll want to share this with your family and friends. Let's start with how redraw facilities work. A redraw facility is a feature offered on many home and investment loans. It lets you make extra repayments on your loan and then take that money back out later if you need it. It gives borrowers a sense of flexibility and financial security, knowing they can access the money in case of emergencies or big expenses. When it comes to saving on interest, redraw facilities seem very similar to offset accounts. Both reduce the loan balance that interest is calculated on. That means more of your repayment goes to the loan principal instead of interest, helping you pay off the loan faster and with less interest overall. And here's the catch: some lenders charge extra fees or higher interest rates for offset accounts, so borrowers often choose redraw facilities to save on those costs. On paper, it all sounds great. But this is where the trap begins, and most people don't realize the real danger until it's too late. Let me show you what I mean with two real-life examples. First, let's talk about John. He owns a home with a $500,000 loan. After a family member passed away, John inherited $300,000. He didn't have an offset account, but he did have a redraw facility, so he put the full $300,000 into his loan to reduce the balance. That brought the loan down to $200,000, meaning less interest and faster repayments. So far, so good. But things changed. John got married and needed to upgrade to a bigger home. So he withdrew the $300,000 from the redraw facility to use as a deposit for the new property. His original home then became an investment property, and the loan balance went back up to $500,000. Here's the problem: when tax time came, his accountant told him that only the interest on $200,000 of the loan was tax deductible, not the full $500,000. Why? Because even though the property was now an investment, John had used the $300,000 withdrawal for personal reasons, buying a new home. The tax office looks at how the money is used, not just where the loan sits. Because of this, John missed out on nearly $20,000 worth of tax deductions. With his marginal tax rate at 45% plus Medicare levy, he ended up paying an extra $9,165 in taxes. Had he parked that $300,000 in an offset account instead, he wouldn't have faced this issue, because money in an offset remains his and withdrawals don't count as new borrowing. Now let's look at Emily. She owns an investment property with a $100,000 loan. She saved $50,000 to buy a new car but hadn't decided on the car yet, so she parked that money in her loan's redraw facility. Seemed smart, less interest to pay in the meantime. Later, Emily found her dream car and withdrew the $50,000. At tax time, she was shocked to learn that she could now only claim interest on $50,000 of the loan, not the full $100,000. That's because the $50,000 withdrawal was used for personal purposes, buying a car, and was considered new, non-investment related borrowing. If she had used an offset account instead, she would have kept the full tax deductibility on her investment loan. So what should we learn from this? If there's any chance you'll need to withdraw money in the future, and especially if you're not 100% sure it will be used for investment purposes, you should seriously consider using an offset account, even if it comes with some extra fees. It could save you thousands in tax over time. If you haven't parked money in a redraw facility yet, you're in a good place. Hopefully, this video helps you avoid a costly mistake. And if you already have, and this is the first time you're hearing how it can affect tax deductibility, I'm sorry to break the bad news, but better now than years later when it's too late to fix. Unfortunately, even refinancing won't undo the damage. But there may be options available, and your accountant or financial advisor can guide you on next steps. If you found this helpful, don't forget to like the video, leave a comment below, and subscribe for more tips like this. I'll see you in the next one.